Okay, continuing on from the idea of organisational growth, we've obviously looked at the positives and negatives of this, but now we can start thinking about how they actually do this one. So it's a bit of a recap on understanding why they grow, and specifically looking at the advantages and disadvantages of mergers, which is one of the approaches or one of the methods of growth. So to move on. Okay, so why grow? As you mentioned before, increased revenue, economies of scale. So economies of scale is the whole idea that as you get bigger, the price to produce one item of unit goes down. So you also gain reputation, market share, more customers, and obviously your chances of survival are increased. In fact, as you are growing, it tends to take the issue of survival off the table a little bit. So you're more focused on the other things, revenue, profit levels, and market share. Survival is really you're guaranteed doing that one. Obviously, on the disadvantages, it can be seen as anti-competitive if you get too big and too powerful, particularly in some specific markets which are deemed to be vital to the to society. They can be legislation can be passed to minimise the company, to close the company down. So on the reverse side, also we get diseconomies of scale. So as a company gets bigger, it has certain issues with communication, for example, which leads to the unit cost, the cost to produce one item, in fact, going up rather than going down. This is, as I mentioned before, communication problems, and also we get this loss of personal touch. There's very much a change in the distance of customers to the market, and that accessibility to our customers, to our target market, may be compromised as you get bigger. So the ways in which we're looking at a business growing, specifically, we need to be aware of these three types. That's a takeover, merger, and organic growth. Now, with our takeover and our merger, these are the sort of things you do hear publicised quite often in the media. Organic growth is possibly something which happens a little bit more in slowly over a longer period of time in the background, but we'll quickly go through these. So when we're looking at a takeover, very simply, it's when one company decides to buy out or take over another company, okay? And that can be done one of two ways. That can either be in a hostile environment, or it could be done as a mutually accepted deal. It can be friendly. So when we're looking at a hostile environment, this is where shares are purely and simply bought by that company looking to do the taking over. All it needs you to do is to buy more than 51% of the shares. And as the shares are available to any member of the public on a PLC, in a PLC structure, it means that these types of organisations are very, very vulnerable to this. So PLCs obviously are big, well-known organisations, and in them seeking finance, they often go out and sell their shares to the public, and anyone can buy them. So if you wish to buy the company, you've got to buy 51% of the shares, and if you then choose to run the company into the ground, that's your choice, it's your company. So it can be very negative. Obviously, that's not really the common reason for doing this one. Obviously, it's just to gain those benefits of growth, to maybe knock a competitor out of the market, to increase your market share, to increase your product portfolio, whatever it might be. But hostile is very often heard out there. Friendly, on the other hand, tends to be very much a mutually accepted deal between the two parties. Very often with organisations with common interests, who can see it in terms of the benefit for everyone involved, for the stakeholders. So this tends to be more of an accepted deal. But again, it's probably done through the way as a PLC, through the whole idea of buying out of shares. Now, without going into the learning about the whole financial structure of takeovers, this is just a very clear overview as to how businesses may choose to grow. On the other hand, we also have mergers. So what a merger is when two organisations agree to come together with a whole idea of joining their resources together. So what this basically could be is the idea that one organisation has strength in one of their resource areas. So for example, one organisation A may have particular strength in marketing to a particular target market. Company B, on the other hand, may not have that strength, but what the strength that they have is in doing their production. They have very good production. So the two organisations, they come together with a whole idea of sharing their resources. One's got fabulous marketing potential, the other one has got fabulous production potential. You put it together and you're going to get a more effective company. Now obviously with a merger, it comes down to the type of contract which is being set up between the two organisations. Okay, so we have three types of mergers. These are referred to horizontal, vertical and conglomerate. Okay, so a horizontal merger. Now when we're talking about horizontal and vertical, we're referring to a chain of production. Okay, so the chain of production is the whole idea that a good or service is produced going through primary sector, secondary sector and tertiary sector. Primary being the extraction of raw materials, secondary being the manufacture or process of those raw materials to add value, and the tertiary being the offering of a service with that manipulated raw material, or purely and simply selling it through retail to the final end user, the customer. So when we're looking at a horizontal merger, it's when the businesses of the same industry, okay, or the same stage of production would merge. So actually, in fact, not necessarily in the same industry. So it could be, for example, I suppose it would be the same industry. It could be like a timber farm, a tree farm, sort of harvesting timber, and a dairy farm. Okay, so they are both in the primary sector. They will both have similar resources, similar sort of things that they could possibly share. One might be much better with using saws. The other one, for example, might be much better at milking cows. Put it together and that could be an example of a merger. Okay, but they're at the same stage of the chain of production. Okay, so this, therefore, as any sort of merger, less competition, gain economies of scale, and hopefully greater market share. A vertical merger, on the other hand, again, this occurs in the same chain of production, but at a different stage. So this could be a primary sector. So, for example, our aforementioned timber yard could be taking over a furniture organisation, a furniture manufacturers. Okay, that would be going forward, going back the other way. Sorry, I keep saying taking over, a merging, but with a manufacturers. Going back the other way would be manufacturers merging with the primary timber yard. Okay, so another example here: a pub taking over a brewery taking over a pub, etc., etc. A conglomerate merger, on the other hand, when businesses at different industries merge, completely different industries, unrelated, at different stages of their production. And the reason they do this is a very good term, and it's called diversification. The whole point of this is that it reduces the risk. It means that if one market collapses or becomes less profitable, they've got resources in another market they can fall back on. Okay, this also allows companies to get into new markets here. The last one, organic growth, very simply is when a company grows from within without any sort of external obtaining of resources in any way, shape or form. So just by increasing sales, customers, getting good reputation, etc., etc. And the thing, it's like a knock-on effect, and therefore we've got increased production, increase in premises size, and also the number of employees. So examples of this in New Zealand: Hell's, Mitre 10, Warehouse, Trilogy Skincare, Frontera. This is something that we all looked at, but these are examples of mergers and takeovers and organic growth that have happened recently.